Good morning, everybody. Welcome to the Flow Show. Welcome to Stel and Kay. Good morning, chaps.
Bonjour.
Bonjour. We're talking French, are we? Oui, oui. Kay's first language.
What's it?
I said K-man's first language.
Was it his first language or not?
Mate, not at all.
That'll upset him. Well, they must have come through Belgium a few times.
No, well, I mean, Brussels is bilingual, but my mother tongue is, well, Flemish, Dutch.
Yeah, cool, mate.
Nice.
So where are you getting your French flavour from this morning? You had a packet of snails or something for breakfast?
No, I don't know. It just came to me. Madame Lagarde.
Oh, right, let's move on from the language lessons before we all embarrass ourselves. Right, let's not a lot going on today, actually. Pretty quiet. Everyone's waiting for this bloody CPR report, the most important data since the last most important data. So a little bit quiet in markets, but there's a few headlines going around anyway. There was a piece out, an economic piece out in China, China press, saying that high frequency data is showing strong investment momentum, and that the country's investment is accelerating and its growth momentum is strong. This focuses on the construction market, which obviously, when you look at property, has been under the cosh a bit. But apparently it's picking up, and whether it's all the measures that the Chinese authorities have put in place, but at least for December, year on year, it's up very strongly for 2022 over 2021, and showing no signs of abating. So that's potentially going to play into this theme that the market is thinking that China, once it gets over this COVID wave, is going to accelerate in the growth stakes, and what China does affects the globe. So that's playing into that theme there. China companies are going to resume coal imports from Australia. Apparently the first batch is to arrive in February. So we heard those lines coming out the last week or so, that tensions are easing there in Australia. That should keep a little bit of a bid in the Aussie dollar. I think the market's probably traded most of those headlines now, but if it opens up to further easing of tensions in other areas, because coal isn't the only thing that the China hit Australia with, there's other measures too. So if we get more of that, then again, that's a bit of a boon for Australia. While we're in Australia, their CPI was out overnight as well, and a strong reading coming in there. Let's see if I get on the right page this time. No, I haven't. Where we go? Never know when it comes out. So there. So CPI coming in. This was year on year. This was a quarterly number, 7.3% versus 6.9% prior. It says quarterly there, but it's actually they've moved to a monthly number as well now, and they have a trimmed mean number, which is basically their core number. That came in at 5.6% versus 5.5 expected and 5.3 prior. So an inflation pickup there is likely to keep the RBA looking to continue hiking, even though they've slowed down. What is needed to be noted, the next RBA meeting is in February. There is going to be another CPI report before then, and this will be for December's numbers on the 25th of January. So because they've switched to a monthly reporting from quarterly reporting, they're squeezing two reports in 1 month. So it could all change in the next report if inflation pulls back again, or it could add to what we've seen in this data with inflation running higher again. So that's going to be pretty important ahead of next month's RBA. If inflation, for example, shoots from 7.3 up to 8%, it might mean that expectations get a bit more bullish or hawkish for the RBA meeting to come. So just keep an eye on that one. Not a lot of people, I don't think, know that there is another CPI report coming before that RBA meeting. Over to Japan, there was a Bank of Japan survey out, and that 85% of households expect prices to rise a year from now, which is down from 85.7 in the previous survey. Again, some might look at it and say, oh, well, that expectations have fallen. But running at 85% is still a high number of households expecting prices to rise in the year ahead. So in Japan, on the ground, price rises are expected. That can make it easier to implement them in terms of how consumer patterns behave if prices are expected to go higher. Of course, it can have a slight negative effect if people buy now to save paying more later. Can create a bit of a jump in demand now that tails off later on. That's something you need to watch for and things like this. But the general theme, as we've been talking about in Japan, is that they're pushing to get prices higher, and households are expecting that to happen. Over to the ECB, Centeno, he knows what inflation's doing. He says inflation could have some resistance in Jan and Feb, but will fall again from March. Amazing. They all know what inflation is going to do now. They couldn't know what it was going to do for a good 2 years previously, but now they're all experts again. ECB's Villeroy said the ECB should aim to reach its terminal rate by the summer. We'll have to raise rates more in the coming months and needs to be pragmatic on the speed of hikes. He's another one who knows what inflation is going to do. In French, inflation should fall to 4% towards the end of the year. We'll see how good his targeting is. ECB's Holtzman says rates will have to rise significantly further to reach levels sufficiently restrictive to ensure a timely return of inflation to target. HICP inflation is expected to subside, but risks remain tilted to the upside amid high uncertainty. Over to the UK and the PRA, which is the Prudential Regulation Authority, has criticised banks in the city for their approach to risk management. This comes despite regular messaging on that. Basically, what's happened is that despite the PRA regularly informing banks about risk management, firms continue to unintentionally accrue large and concentrated exposures to single counterparties without fully understanding the risks that could arise. This sort of crap should not be an issue in 2023, given what happened through the GFC and the banking crisis and all that sort of stuff, which was purely aimed at reducing risk at banks. But it seems people were still not learning their lessons. What the PRA are going to do about it, apart from write letters, is another question indeed. But they are warning that banks are still taking big risks and not understanding a lot of those risks. Over to the US, Fed's Bowman said continued rate hikes are needed to curb inflation, and they're seeking compelling signs that inflation has peaked. It has declined recently, but there's a lot more work to do. The size of hikes and the ultimate rate peak is to be data dependent. And just before we came on the flow show, there was a headline out that a Russian rights commissioner said it's important ceasefire proposals have been made in a meeting with Turkish and Ukrainian colleagues. We're not quite sure the context of this. Risk assets haven't moved, so it doesn't suggest that anyone suggesting that a ceasefire is being put on the table any which way. So, as I say, not really sure the context of these lines. We haven't seen markets move, although we are getting a bit more comments on ceasefires and stuff coming up. We had the Christmas one, or the Orthodox Christmas one, earlier in January. So we don't know. It's one to keep an eye on. I'm not saying this is any big news, but these comments are being made. Before I go into another piece, just want to get the thoughts from the guys. Anything you want to add into the mix of headlines, or any comments on anything said already?
No. Not really, no.
Okay.
No, not really, mate. No. before you talk about CPI, there hasn't been much going on really.
No, cool. Well, I saw a post that our mate Gavin put up in the newsroom, which is quite interesting, from Reuters, saying, "Move over, Tina. It's time for Tara." Now, TINA is the acronym that's been used over the last few years. There is no alternative, basically referring to investors had no other place really to put their money for gains than in stocks. So there was no alternative. And that now, with rates rising around the globe, there may be another alternative for investors to place their money. The main gist of the story is coming from PIMCO, so probably a bit of a book talking sales pitch, but it does emphasize something we have spoken about before on prior webinars, and I think on Face as well, that we are entering a potentially different world with rates going higher. Obviously, central bank easing is coming to an end, the liquidity is being drawn out, the free cheap money that everyone piled into stocks is disappearing. So investors are going to be looking to move their money around the various different assets. That means putting money into bonds where returns are now higher because the yields are still higher. I won't get into the inflation part of that equation, but if you wanted to park some money somewhere, you couldn't do it in bonds earning 0.5% for the last 10 years. Now you can park some money away, 3, 4, 5%, and leave the money to sit there. It's a different situation now. We haven't had an environment with rates this high for many years and potentially stand this high for many years. And it is going to change the investment landscape. It is going to change where flows go. It's going to change around all your prior risk trades, as we've been mentioning. So if you want to take a look at that, as I say, Gav put it in the newsroom. I'll stick it in the chat here as well, just so you can have a read. As I say, take the PIMCO sales pitch out of it and just look at it for what it actually means about investment flows, because that's going to affect things like currencies, where the money goes, and the different assets that may or may not gain or lose on the back of it. I want to bring you guys in on that. You know, you've got a few years under the bridge, guys. It is a different world we're coming into, isn't it, with higher interest rates and how investors are going to define that and move their money around, isn't it?
It is different to what we've seen over the past decade and a half. But the main difference for me is not the rates themselves. We were at 6% rates in the UK when I was market making back in the mid 2000s, early 2000s. The problem today is inflation. That's the problem, and that's where we are very different. So suddenly, a whole asset class, which used to be, at least for me, a complete red light, which is bonds, so suddenly it's become very attractive, or it's become more attractive than it used to be, and that's definitely changing things in terms of being an investor. But I think, unfortunately, for markets and for everything, I think that rates are going to go back down, inflation is going to go back down, and we're going to go into not the same that we had over the past 15 years, but kind of a quasi-quarting, a similar situation like we used to have over the past 10 or so years. So it is a very different market now than it was a couple of years ago. But which is good, which is good. You won't have proper price discovery of, risk being priced properly. You used to have negative yielding bonds. You used to have junk bonds at, 3%, which is ridiculous. It is different now, but in my opinion, I think it's going to be a little bit short-lived, unfortunately. And we're going to go back to a similar situation than we had before we then get the what I think is going to be a big blowout in pretty much everything. But that's not now. This is going to be years from now, I think. But just to summarize, I think we're going to see the can getting kicked one more time. That's the executive summary for me.
So you see rates going all the way back down, or I'm
not to zero, but I think there's going to be more easing, led by the Fed.
Okay, Okay,
I know,
cool. Okay.
controversial, but I think that's what we're going to get, unfortunately.
Well, I mean, we know that they're going to get to this and then bring rates down to the neutral level, and that's going to be the trade after they pivot. You know, expectation of where rates will drop down to, but that's probably, you know, another stage ahead of what we're trading at the moment.
Yeah.
So that is to come. What are your thoughts, Kay?
On this article, I think it means what we've been talking already about is more volatility, and we've already seeing it. And investors are, and just talking about the article, right? Investors are looking now for where to invest, but they are going to have to be more choosy. They will have to reckon with and us as well in the FX market, as a matter of fact, because bond traders or money managers influence FX, of course. It's going to be more a case of volatility. You can, and we're already seeing it since the start of the hikes, and inflation-led, growth-led moves. So that's really what it means, and which really brings it back to what we have been saying, and now the global investors market is looking at it pretty much the same thing as we were saying, that is more volatility. You're going to see more shifts between one and the other, investment grade, high yielders, where people think their money is the safest, and that's what we are going to see. For the time being, there's still a lot of money. What is it? The deposit money accounts or so parked in the repo, because they are getting a lot of free, in between brackets, risk-free yields. But that's, I think, if there's, as they say, there are reasonable alternatives, then we should see some of this money getting placed back to work, and then we are going to see moves between the different investment classes. I think that's what what I take away from this article, which is relatively what we have been saying, that there's going to be just more volatility, which is inherent to a higher yield. If yields everywhere are at zero, you have stability, and even great stability, and that's what we've had for a lot of times. Because if you look at it, in between the crisis, where money flees and doesn't know where to go, and gets repatriated and stuff, apart from those crises, we have seen very, very stable markets, You could, dollar yen was, like, to take any for an example, dollar yen was sometimes moving 15, 20 points a day. Now we are moving 100, 150 points a day. And I think that is what it means for us, reading through this article, is that we are going to see continued volatility, because they are going to move around more between different assets.
Yeah, no, exactly, mate, exactly. And a couple of points made. Gurkham says that at the end of the day, governments will not borrow at high prices, and will put the whole burden on the people again. Yes and no. They will borrow because they need to borrow, and they have to borrow whatever rates the market is at the time. There is no alternative. There's no TINA for governments. They need to borrow. There's no other source of income they can make apart from taxes, and you only get taxes really if your economy is running really well. But on the other side, and RA alludes to this a bit as well, rates must go down with low inflation rates because of the increased amount of debts. Well, again, inflation helps inflate the debt away. So it helps with debt levels as well. Where the crunch comes is if inflation is lower and rates are high. That's where you get in a bit of a pickle. So that's potentially another reason why, when or if inflation gets under control, we're likely to see rates coming down fairly quickly, because there will be that big gap then between what inflation is and what interest rates are, and that will be an impact on debt levels and stuff like that. But again, this is This is stuff further down the line. Quick before we move on, Paul Landon has joined us. Paul, I tried to get in contact with you because you came up trumps in the NFP competition. So if you want to check your Twitter from the guess you made on there was a reply on there. I tried DMing you, but the DM didn't go through. So check that out. Yes, you did win in the competition, a free month on the platform. If you want to come and join us, just let me know. You know how to contact me, or do it via Twitter, whatever you want to do. Right, so moving on, let's have a look. What do we want to do? Yeah, you can email me, Paul. I think we've had a conversation before, so you should have my email address. Yeah, or via Twitter, however you want to do it, mate. Right, euro dollar pretty much tells the story of what's going on. Not a lot, sideways. Everyone's waiting for CPI. There's not a lot we can do about that. The market had a busy one last week, and just is taking its foot off the gas really at the moment. So nothing too inspiring going on. Dollar yen is finding a little bit of a creep up, edging higher, but still really not doing anything really of note. I'm not playing this one at all at the moment. I want to see if we get moves to the edges of this 134, 129's region. Aussie dollar, we had a little dip yesterday. I did try a bit of knife catching at 68.74 yesterday. I was going to add a bit more into 50 down here. I was a bit concerned when this area broke, this 70-80 area, because that was my level of support where we had the break, and I wanted to see it holding. It did start to hold, then it broke, then it went all the way through. I don't like my tech being messy. I like nice, defined levels like we've seen here and here. But it's back above, back into 69. Now it's holding that area again, so a bit more constructive in looking at the upside. But not even a move really close to the highs. So we may be setting up for, again, a bit more sideways action. Maybe we'll see the CPI kicking into gear. We could see it busting 69.50. Conversely, if we start to really hold below this 68.70 and get below 68.50, it could mean a quick trip down to 68 or even worse than that. For me, I'm going to see this little bit I put on yesterday. I'm going to hold it. I've sliced it off on the way up. My latest one, 69.14. So I'm going to see if I can keep hold of this one for a while longer, but I'll keep my stop not too far behind. Euro sterling's having another look up towards the highs. I know Kay's been in and out of this like a, well, I won't say what like because it's a bit rude, but he's been in and out of this one on both sides. We are having a little mooch up towards the highs. I don't see any real catalyst why we should get a decent break. We might just get a bit of a blow off the top after a few stops and the like, but I would expect us to run into trouble into the big figure at 89 if we do. Again, the downside, need to see really a break under this 75-80 area and it holding. If that happens, then again, probably can have a look down at the low 87s fairly swiftly after that. Same again on the upside. If we do break above this area, 60s, 70s, maybe even called up to 80s, want to see it becoming support up here. We've had a few tries. It hasn't held, hasn't lasted. Back down. As soon as we start to see it coming in as support on a break, then that gives a bit of an idea that we're going to move on up. One other pair, long held pair, is my dollar Hong Kong. Let's go into that one. For those that may not know, I've been trying to play the band that's in play here, 785, 775. Didn't quite get my 776 where I was looking to get out all the shorts that I took up into here. We're a bit middle at the moment. I will be looking to add back into that short if we get up to here. Pretty low risk trade on the face of it. So happy to try and play the edge of the band there. Guys, you got any inspiration going on today?
I don't think anybody has anything going on ahead of tomorrow. Although the markets seem to be once again trying to anticipate more weakness and more pivoty Fed, let's say. So, you know, it goes without saying, tomorrow's number is the most important number of the month. And where we are now with the market playing chicken with the Fed, it's crucial. You know, it's if for whatever reason, I don't think it's going to happen, but if for whatever reason we get a stronger number than expected, the reaction is going to be strong. If we get expectations or maybe a little bit weaker, I think the reaction is going to be much smaller. But the fact remains, the Fed are telling us one thing, and the market is not buying it. So who's going to win in the end?
Yeah,
I don't know.
Mate. No idea.
Yeah, I mean, I've said for weeks and months, I think we're going to see a lot lower inflation prints this year. You know, I was talking about the end of Q1, and I still think this is the case. However, you know, you could get if tomorrow's print is not as soft as expected, you're going to get a pretty potentially violent move the other way. And I'm kind of hoping we get something like that, because I really want to get short the dollar and I want to buy more silver. I want to get put a few trades on, but I don't think we have broken out yet, you know, in any of these yet. You know, there's so many FX pairs that are kind of on the brink, and we're waiting for tomorrow to either get confirmation or we get a nice reversal. So I'm personally not doing much ahead of tomorrow.
Yeah, understood, mate. Kay, come on, give us something.
You want us to look already at some stuff, or do you want to?
Yeah, you can. Yeah, you can do, mate. Do you want to take the DAX? Richard's asked a question about the DAX. I mean, just to throw my.
Go ahead, look at that first, because I have no clue.
Yeah, I was just going to say, just to put my quick opinion in, it's not just the DAX that's moving high. We are seeing a general bidding.
Scratching their heads about why the DAX is moving higher.
Yeah, exactly. But it's not, you know, it's not just the DAX. You know, the FTSE's looking fairly strong as well. Other indices stock indices are looking fairly strong. S&P's looking decent. I think it's just this. There's two narratives, I think, and I'm not sure which one's playing out. Is it the fact that maybe we're heading for soft landings and that's going to be underpin stocks, or is it that inflation's coming down and the risk trade is playing in, where lower rates or interest rates maybe not getting as high is going to keep the cheap money wagon rolling a bit longer? I think we need to see what develops, and watching the data is going to be important. Is good data going to lift stocks or send them lower, or vice versa? Is the risk trade changing to what we've seen the last few years? Anyway, Kate, go ahead, mate.
Yeah, okay. Okay. Let's look quickly ahead of what may happen on tomorrow's tomorrow's CPI. I think the major one is going to be this one. There's the US 10s. They're likely going to go into tomorrow around 360, and then we have this is in the short term, I'd say 365-ish, but I think the more important one is going to be around here, around 370, 375, and on the downside we're going to go 350, and then the prior lows 340. So to me, for tomorrow CPI, this one is going to be, and we know it's a big driver for dollar yen, for instance. This one is going to be mega important to see where we are going during the day tomorrow. And I reckon if 350 and 365 are a bit close, which maybe, we will have to monitor this 340 and the 370-75 zone on the US 10s, because they are going to ultimately, in my opinion anyway, decide where the dollar is going to go, and especially dollar yen, for instance. But you can include a lot of dollar pairs into this scenario. And the other one that I am very, very closely watching right now is the differentials on the 2-year, and this is part of the reason why euro is doing what it's doing. And we've been talking about that, and I've been saying it for a number of times now. You have to watch what's going on here. And I think with the ECB trying to play catch up, and with the data in Europe, as we have seen the first set of data coming out last week not being too disastrous, we've seen this move higher. So this is inverted, right? So if it goes lower, the differential between European and US yields increases. If this comes up, it decreases. So, and we have seen since November, really, when the dollar turned, we have seen this gradually move up. We have seen this early last week, early last week dump. The first day, couple of days of the year, the dollar making a comeback. This was kind of good overlay with this move, and then since then we're moving higher. And the other one to have a look at it, to have a look at is this one. And we know that that's the differential between the Italian and the German spreads, and that's a really good benchmark for knowing where the stress levels are. And we know that when it was trading above 200 BPs, above 2%, there was some stress. And if you look at the highs, those are not far from where we see where we have seen the lows of the euro as well, and on the euro crosses. This one coming down is a sign of less stress in the European markets, and that is the other explanation why euro crosses are performing like they are performing. We wonder sometimes why euro is doing what it's doing. Euro dollar is moving that much, but if you look at the euro crosses, if you look at, for instance, the euro yen, it's quickly pulling it up. Euro yen, if you look at the differential coming down between the EU and the US one side, on the one hand, and the peripheral spreads coming down, this is nearly a mechanical move. And that's one of the reasons why I've been in this little long euro yen trade as well. And I also think that it's partially the reason why we are here now as well in this last move in the euro sterling. So coming back to what's going to happen tomorrow, I think for those trading pure dollars, keep an eye on in the short run, 365, 366, 350 on the downside in the US 10s. That's going to be the driver for the dollar, in my opinion, the main driver for the dollar, in my opinion. And then besides that, look at what the rest is doing. If those euro differentials continue to perform better, euro dollar could be, if the number is lower tomorrow, euro dollar could be really explosive. If in turn the number is higher tomorrow, we are going to see a bit of a hurt, I think, in the market, because as we have repeatedly been saying, the market is trying to find the pivot. The market has done it with some success because the dollar is lower versus most of the currencies over the past weeks and months. But if we get a high print here, that's going to have some people scratch their heads, and the dollar could really put in a bit of a nasty, in my opinion, short squeeze. Now, bringing it back to the euro, if this is the case, and with what we know on those differentials here, peripherals doing better, and then well, let me get back to where was I before, and then these differentials with the euro having risen. Euro dollar may be one who doesn't collapse as much as other dollar pairs. So I reckon that may be even another reason for the euro crosses to perform better. So that's a little bit correlations between yields, between what the bond market may do, and correlations with yield differentials, about what may happen tomorrow, and the levels that I'm going to look at in the yields. Still, are you still around?
Of course I am.
Do you have any comment on what I just said? Agree, disagree? Do you think tomorrow? First of all, the question is: do you think tomorrow, having been a rates market maker, has the power to break any of these levels?
Yes, I think we can break to the upside. To the downside is a lot tougher, because think about what we're pricing in terms of yields and in terms of rate cuts. So let's say we get a slightly disappointing CPI, so slightly lower, 0.1, 0.2 lower than expected. How much more than what's priced in do we think the market can go ahead and price? I think the move, we could test these lows at 350 in the 10-year, but for me, the move, we could break out of that descending resistance trend line that you have. That we can break out very, very easily. I mean, we could go up 25 basis points in a day, I think, if the number is strong. So for me, that's the skew at the moment. Having said that, I think the probability is more likely for us to get a inline or maybe mildly disappointing CPI. So, I'm not saying, sell bonds here, because I think the most likely scenario is we get a slight disappointment. But if we don't, then I think the move higher in yields is going to be a lot stronger than with the opposite in the opposite direction.
I agree. I agree.
And that's why I'm still not fully convinced about silver and about metals, even though gold is still going. Silver has not broken out. We need the daily close above 2450. That's how we've said that for a while, and we haven't got it yet. So
that's the one.
Exactly, that descending trend line. Yeah,
that is the one. That's the magic level that we are going to have to monitor.
Exactly.
If this thing is going to continue to fly. I fully agree, and that's a good transition to watch this one. So what we've been saying of late is still valid. I mean, the 24.5, get a close above, and this thing should be flying. If not, we could muddle on here, because yesterday there was this, and it was very tough to decipher for me, at least. There was this Adobe. Or Adobe, I don't know, I don't even know how to pronounce it, inflation data coming out, and that showed the slide to continue. But if you look at the comparisons, and the magnitude was very difficult to decipher for me, but it should show a continuation tomorrow of the slide, but it's very unclear to what degree. Overall, looking at it, we may be getting a data number close to what the market is expecting. That is a slowdown to what is it, 6.5 from 7.1, and then the core getting back sub 6% towards the 5.7. But I fully agree. The surprise trade tomorrow will be a higher number.
Yeah, and again, to reiterate, I'm not saying this is the most probable scenario. You just need to know which way the market's going to react more.
Yeah.
One way or the other. No, and I think that's my opinion. Obviously, I could be wrong, but that's what I think.
Absolutely, and the sensibility perhaps or the sensitivity to which currency may react the most, we can keep that perhaps for tomorrow. In the meantime, gold. It's just going on. I mean, I don't know whether it's Russia, China still buying, but at least we are gradually climbing to this 1900 level, and who knows? We could be trading around there, buying on CPI tomorrow, and it's going to be an important one, right? If we get a close above or below 1900, especially above. If we close above $1,900 tomorrow on gold, why not? Why not do those extra $75? Who knows? It's been relatively volatile of late. Well, at least it moves, volatile. But last few days, it's hanging there and stubbornly stubbornly looking towards that 1900 level. So keep a close eye on that 1900 level.
Yeah, on gold, just one note. I've talked about this, I think, here and on Face and on the Morning Edge. It was really strange. In 2022, gold dropped from the highs at 2000-ish down to the low 1600s. And this was because we had inflation, right? Because everything's getting more expensive, inflation everywhere. So the Fed, what do? They hike rates, and the dollar strengthens, and gold drops, gold and silver as well, obviously drops as a response. Now, the really weird thing is that we are effectively getting gold price dropping because things are getting more expensive. I mean, how silly does that sound, right? If things are getting more expensive across the board, obviously something like a commodity or precious metal should also be going up as well. You could argue that against other currencies, gold barely dropped in 2022. It was all a dollar move. So yeah, that is part of it, but simply because the Fed is hiking rates to combat inflation, to combat rising prices, doesn't mean that something which is of a finite quantity should be dropping, right? It just doesn't make sense. But this is the knee-jerk reaction that the markets always have, and we are seeing a reversal of that move. It's as simple as that. So
it's really reacted violently to the setback that we've seen in yields for one. But then I think we have to look east to get the rest of the explanation, because we have seen the reports that as well Russia as China have been buying a lot of gold in November and December. So there are those flows behind this move to support this move.
Yeah.
And thanks for that.
One more thing. One of our friends is here is talking about miners and how they need loans and debt. Yes, miners run on debt, obviously, and yields will affect their performance, their share price, of course. But think about it. If yields go higher and it becomes more difficult for miners to operate, then supply gets reduced. so that theoretically should be another driver higher for the actual price of the underlying. So anyway, you are right about miners suffering because of yields rising, but that for gold itself is probably not a negative, perversely enough. Anyway, let's carry on.
Alrighty, thank you, Stel. Just for the day, looking at some of the stuff. I mean, as Ryan was already mentioning, I've been in this really since we started to break here, but then been doing the washer dryer program, rinse and repeat. It comes down, buy a few, goes up, let a few go. And the reason why is that the reason why I've explained on the euro, ECB, less stress in the eurozone for now, at least on the peripherals, and that's a good enough reason, together with my bit of a aversion towards sterling and the way the Bank of England is trading it, or handling the situation. Yeah, for various reasons, strikes and stuff, I think sterling could still remain under a bit of pressure. But also the main reason why I am, I'm going to have to clean this up. Also the main reason why I am cautious with my longs. What the hell is this doing here? Okay. So the reason why I'm cautious with my position and not just blindly stay long, but trading it around, is this one. And that's 89.13, which is the 50% of the whole move, the whole setback that we've seen during the 2022. That's the Truss and Quarteng spike. The whole move lower is around 89.10.15, and I think it's a pretty cool level We are not getting there right now, so we could already argue that 88.75 is going to be the level. But I still would like to pay, well, personally I am anyway, to pay attention to this zone. And for as long as this doesn't break, I'm going to continue to let some go on rallies and trying to get them back on dips. And that for as long as my 86, 85, 87, the figure holds. If that starts to break back down, I think the party is over. In the meantime, there's a nice few pips to grab, and it greatly improves the average on the core. So I'm more than happy to just continue to trade this scenario for now. The other one, as people in the room know, I've been looking for this euro-yen to perhaps get a look back into the 143. Similar kind of reason, and I'm a little bit cautious on the dollar. I'm not really a great fan of having too many dollars in position. But yesterday on Face, I told the people that if there is one that I would catch a knife in is perhaps dollar yen again, if we see it back to 130 or below. But in the meantime, for as long as the Bank of Japan keeps on defending this 0.5% top end of the JGBs, I think the yen will still, as it is a very low yielder still in the whole spectrum. There's not too many fundamental reasons besides what BOJ may do to be long yen for a longer period. So I'm looking for a move. I'll be happy with a move here. Unfortunately, I didn't have the nerves to catch the knife here on the first day of the year, but I've been trying to accompany this move higher and be a happy camper here, especially into tomorrow. I don't want to have too many positions going. Another one which should be relatively unaffected by what's happening on the dollar side, because they have been moving pretty much in tandem, is this Aussie Kiwi. That one held the underside of this little flag, and now is trying to make a move back above. I have a little bit of it. To me, the magic level here is 108.780.85. We've seen it here, double bottom. When we crashed through it, we went really fast on the RBNZ RBA divergence, and now we are gradually crawling back up. Aussie helped by, well, first of all, the RBNZ RBA trade seems to be over now, and we've seen the Chinese looking at it, looking at the Australians a little bit more positive on the trade side of things. So I think the Aussie has a little bit of an advantage right now over the Kiwi, but we have to respect the level. For as long as we are below this 108.80.85, I don't think that it's worth really adding for a spike higher. But I'm looking to add a bit into this 107.10.40 zone. Yeah, Lucas, Euro Aussie. I'm not trading it right now. I know this few people very successfully trading this Euro Aussie from the long side and the short side, because we are in this yo-yo. But to me, yeah, I mean, it could be kind of a flag to ultimately move higher, perhaps. Yeah, there's support 154.15. That's been trading as well by the people in the room, and then 156.25.30, first bit of resistance, I'd say. So that's your goalposts right now. The reason why I'm not trading it is that I'm actually long Aussie and long Euro, so I'm not really inclined to fight one side or the other. But I mean, Aussie being less liquid, if the positive news continues to come out for the Aussie, it might just be because of the liquidity. Just continue to play this ping pong, despite euro strength. But if euro really picks up speed and strength, this one could, why not, go back to higher levels. Now, and that brings us to me, at least. I'm never looking at DAX, but then since people were looking at talking about the DAX, I know this is not the DAX, this is the S&P 500, but since people are looking at the DAX, I mean, my theory at least is that this thing has been, the S&P has been in a bit of a yo-yo, and yesterday we saw, beginning of the week, we saw the S&P come down and DAX still pulling higher. I think there's a bit of rebalancing going on between European and US assets. And it may all be part of that big play where the euro is in its correction phase versus a lot of stuff. So also, if China reopens, as people were already commenting, it may be not too bad for the euro as well somewhere, because the eurozone is less categoric anti-China than the US may be. So I think this part of this DAX move could be explained by some rebalancing between people getting out of other equity markets and a little bit more into European equity markets. But that's just my wet finger up into the air. And with that, my friend, where is that, Lucas? Yeah, okay, Lucas. Yeah, with that, I give it back to you. It's enough for today, Ryan.
Thank you very much, mate.
Thank you, Kay.
Screen quickly. Yeah, just while we're on the stocks and stuff, if you want to look at something that's potentially on the cusp of a big breakout, look at the FTSE, right up near all-time highs, looking very strong there. You have to remember that it's not a true reflection of UK firms per se, because it is full of a lot of international companies and so on and so forth, and some of the more UK-centric indices like the 250 and the like are not up at such highs historically. But if you do trade the FTSE, keep an eye on that one. We're very close to this 78 area, a long-term high. So, you know, again, it's playing into what we're seeing in other stock markets, a bit of a bullishness coming in there. Charles asked a question, which currency pairs, dollar crosses and levels are you eyeing ahead of the CPI tomorrow? I haven't started doing my homework yet. It's an exercise I advise all traders to do ahead of events like this. Go over your charts, look for your levels. You don't really want to be looking at levels probably 50 pips either side, unless they are something big. So, for example, if you're trading the FTSE, keep an eye on the 79 level, 78 level, because we're only a few away. But if you're looking at something like, you know, euro dollar, bear in mind we've got a big area coming up here that we spoke about yesterday, this 108 to 109 area. That's going to be a big one. These are the sort of areas you note on your charts. If we get data that shows some dollar weakness or would lead to dollar weakness, these are the areas that need to be broken. If we can't break that on the data while other pairs are going, it tells you what you need to do. So you go through the charts, you have a look at the levels, you know, from maybe 100 pips either side, keep a note of them, list them down if you need to, put them on paper, list yourself 2, 3, 4 different levels, and those are the ones you watch, because it's very hard to grab a trade going in the right way as the data comes out. The time you've taken to assimilate it and assess it, the price has already gone. Market's far quicker than we are. But if you've got your levels in play, you know what to do if you get to a certain level. If the data's strong but not really strong, it doesn't change anything with a Fed, but you see a market move, you know that's likely to be countered. For something like dollar yen, you know, we've been speaking about the range that we're potentially looking up here, these mid to high 134s, down here in the 129s. So any data that comes out, unless it's a huge variation, these are going to be good stretch points either side if we get there. It's going to take some big data to get there probably, but they potentially mark good stretch points, and that's where you're going to lean your risk against. So go through the charts. I do it every time there's big data, NFP, Feds, FOMCs, Bank of England, you name it. I go through the charts, I pick my levels, and I say, right, that's a level I'm interested in if we get there, that's a level I'm interested in if we get there. And then you judge it at the time, and you have a trade or you don't. But one thing I will say, just to throw in on that, although I say when the data comes out, ignore the levels in maybe a 50 pips either side, don't ignore them if the price has moved away and then we come back. That's when you take a bit more notice of them. They're not going to matter on the volatility straight over the data. As soon as the numbers drop, it's probably not going to matter. But if we move up to 134 and then come back down again, some of these areas that have been broken, they may come back in as tech levels. That's what you need to look at. So if you've taken a trade up here, that's where you may want to look to take profit, for example, if we come back down, so into that old fib and the levels we've seen previously. So, Charlie, do your homework, mate. I'm going to be testing you all tomorrow ahead of the CPI. And on that note, we shall call it a day. Thank you very much, as always, to you guys and girls for coming to the Flow Show and supporting us here. Thank you, as always, to Lestelios and Monsieur Cayman.
Merci, monsieur.
See you all tomorrow.
Cheers, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.